Hi, this is Brian here, and today we'll be talking about the ACCA F5 paper for the March-June 17 sitting. You can download this paper on the ACCA Global website. So we'll be looking at question 31 from section C of the examination, and we are looking today at part B of the requirements, which is calculate the labor efficiency variances is as much detail as the information allows. So let's take a look at what the question says. The first paragraph, which you can see over here, is not really relevant to answering the question, so we're going to take that out. And the second paragraph has a lot to do with materials, so that's also not very relevant. We are also going to take that out. So let's take a look at the third paragraph. The manager of the sewing department expects each new dress to take 10 minutes compared to 8 minutes of the old style. So that means there has been a change in the amount of time taken for the dress to be created. We're going to highlight that. And SU Co has 24 staff, each which work 160 hours per month and is paid a wage of $12 per hour. That's pretty important. We're going to highlight that as well. There is no idle time and no labor rate variance. So that's all the data that we have. You also have the actual production and sales, which is given over here. As I've mentioned before, when it comes to F5 questions, especially for planning and operational variances, we will want to focus on the actual production. Okay, so we are not going to use the budgeted production. So I'm going to cross that out over here like that. Okay, so the this paragraph also not important. There's nothing there that helps us to calculate anything, so I'm going to cross that out as well. So you see, when you go through this process and you read the question very carefully, you find that you can minimize the amount of effort you need to do in reading all that stuff. Okay, so let's talk about the labor efficiency variance. You will have to calculate a planning and an operational variance, and you're not giving a lot of information. So first of all, you will need to calculate your standard quantity, your standard time at actual production. Okay, so in this particular scenario, they say it would take 8 minutes per dress. So we're going to put here 8 over 60, multiply by the actual production, which is 24,000. So this should give us 3,200 hours. So this is the amount of time that we were expected to take. Okay, then you need to calculate your revised time at actual production. So in this case, we have the company has revised the new dress that is now going to take about 10 minutes compared to 8 minutes. So now we're going to write here 10 over 60, multiply again by the actual amount, 24,000. That should give us 4,000 hours. So straight away from here, you should be able to tell whether the variance is favorable or not. And finally, we will have our actual time, which is taken. And in this case, they gave us the total working hours of the staff. There are 24 staff over here, and they work 160 hours per month. So I'm going to take 24 staff, multiply by 160 hours, and that should give me 3,840 hours. So from here, we're now going to start calculating our variances. The first variance we're going to do is the labor efficiency, efficiency planning variance, which is very simple. It is the difference between the standard time and the revised time. So we're going to take those two. We're going to take 3,200 minus 4,000 hours, and we're going to multiply that by the standard rate. Now in this particular question, they said that the rate is $12. They didn't really give us any other rate, so let's just take the $12 over here. So that should give us 4,000 minus 3,200, that gives 800, multiply by 12, you'll get $9,600 adverse. Now the reason why this is adverse is because you have an actual increase in the time you expect to spend to make the dresses. Okay, and now we're going to calculate the labor efficiency operational variance. So that will be the difference between the revised time and the actual time. So let's just calculate that. It will be 4,000 minus 3,840 multiplied by $12, which is the same amount. So let's just take that 4,000 minus 3,840, then multiply by 12. So you will get 1920 favorable. Now the reason why it's favorable is because the actual time is less than revised time. That means you actually save a bit of time, you save a bit of cost. So this would be the answer to your questions. The labor efficiency planning variance is 9,600 adverse. Labor efficiency operational variance is 1920 favorable. This means that the labor efficiency variance it would be 9,600 minus 1920. That will give you 7680 adverse. Alright, that's all. Thank you very much.